Beneficient, trading under the ticker BENF on the NASDAQ, is a micro-cap financial services and technology company focused on providing liquidity and administrative solutions for alternative assets. The company's core mission is to create an accessible marketplace where investors in private and illiquid assets can exit early, a service that traditionally has been reserved for large institutional players. Its platform aims to streamline the process of valuing and transacting in alternative investments, which is a growing but often underserved market segment. The company's history is complex. Beneficient emerged out of a series of transactions and restructurings related to the GWG ecosystem, and has endured a challenging past marked by litigation, regulatory scrutiny, and internal control weaknesses. Management today is working to stabilize operations, reduce costs, and rebuild trust with investors. In recent quarters, the company reported meaningful reductions in operating expenses, with costs declining thoroughly, $14.3 million in the most recent quarter, a reduction of over 90% compared to the prior year period. This cost discipline is critical as Beneficient attempts to conserve cash and extend its operating runway. Financially, Beneficient remains in a precarious position. Its most recent filings show cash on hand of roughly $4.15 million and total debt of approximately $122.94 million, resulting in a net debt position of about $118.8 million. Operating cash flow is negative at around $37.9 million, and free cash flow is similarly negative at about $39.3 million. The company reports a loan portfolio of approximately $244 million and collateral investments totaling roughly $291 million. Revenue remains minimal, with quarterly revenue in the low hundreds of thousands and ongoing net losses of several million dollars per quarter. Over the past few years, annual revenue has declined at an average rate of over 40%, while earnings have contracted by more than 30% annually. Return on equity is deeply negative, reflecting ongoing losses and the strain of the company's capital structure. From a fundamental perspective, Beneficient's long-term thesis rests on its ability to capture a share of the growing market for secondary liquidity in alternative assets. As more wealth managers and individual investors allocate to private equity, venture capital, and other illiquid strategies, the demand for early exit options should rise. Beneficient's technology platform, if it can scale, could become an important facilitator of such transactions. However, the company must overcome significant hurdles, including strengthening its balance sheet, achieving consistent revenue growth, and resolving the lingering governance and legal issues that have weighed heavily on investor confidence. A SWOT analysis helps frame the investment picture. The company's strengths include a differentiated focus on alternative asset liquidity and a technology-driven platform that could scale fee-based revenues if adoption grows. Its weaknesses are significant: small market capitalization, negative cash flow, high leverage, and a troubled history that raises questions about management credibility. Opportunities lie in the long-term growth of private market investing and the need for liquidity solutions. Threats include potential new regulatory actions, renewed litigation, macroeconomic stress that could impair its loan portfolio, and competition from larger, better capitalized firms. For technical traders, Beneficient stock exhibits extreme volatility and thin liquidity. The share price has recently traded around 65 cents per share with wide intraday swings, occasionally spiking on corporate news or filings. Because of its small float and micro-cap status, technical indicators often give false signals, and price movements can be exaggerated by relatively small trades. Anyone trading this stock should exercise strict risk management and be prepared for sudden and unpredictable price changes. Looking at valuation, Beneficient's current market capitalization remains very low relative to its reported assets, but its negative cash flows and ongoing losses make traditional valuation metrics less meaningful. A successful turnaround could unlock substantial upside from these depressed levels, but execution risk is extremely high. Investors should demand a significant margin of safety and only consider small, speculative position sizes. Based on the potential for operational improvement, cost reductions, and exposure to a growing market for alternative asset liquidity, I would issue a high-risk speculative buy recommendation for Beneficient. For investors with a strong tolerance for volatility and a multi-year horizon, a near-term conservative price target of $1.50 per share is achievable if the company demonstrates continued cost control and begins to grow revenue. A more aggressive 1 to 2 year target could range from $3 to $4 per share if management successfully resolves legal issues, strengthens the balance sheet, and establishes meaningful partnerships that drive platform adoption. However, it is critical to acknowledge that downside risk remains substantial, including the possibility of dilution or a decline towards zero if the company fails to execute. This is a deeply speculative investment suitable only for those willing to accept significant risk and potential capital loss. Position sizing should be small, and investors should closely monitor financial filings, litigation updates, and revenue growth metrics for signs of sustained progress. If you found this deep dive helpful, please like this video and subscribe to the channel for more detailed investment analysis and future updates on niche and overlooked companies.